Good morning, everyone. My name is Mark Steer. I'm the Executive Director of the Pennsylvania Policy Center. We're here today to discuss corporate taxation in Pennsylvania. We're going to be announcing with national partners the release of a new national report from ITEP, the Institute on Tax and Economic Policy, entitled A Revenue Analysis of Worldwide Combined Reporting in the States. This is an important topic in Pennsylvania for three reasons. First, as we at the Penn Policy Center have argued for some time, Pennsylvania has one of the most regressive state and local tax systems in the country, in which the richest 1% pay about 6% of their income in state and local taxes, while the bottom 99% pay 11.8%. Second, we badly need new revenues. Governor Shapiro's budget proposal for the fiscal year beginning on July 1st calls for expenditures that exceed the revenues the state will raise in that fiscal year by $4.4 billion. We can get through the year by drawing down some of the over $11 billion surplus the state still holds, but without new revenues, the surplus will run out in the next 2 to 3 years. Third, Governor Shapiro has called for some variant of the policy we are discussing today, combined reporting. So this is a good time to look into the rationale for that policy, the variants of it, and the revenue it could raise for our state. The report will be officially released tomorrow, Wednesday the 20th, but we will send members of the press a draft of it this afternoon. We ask that you not discuss it in detail or quote from it in your reporting until tomorrow. We have three speakers today. I'm going to introduce them, all of them now, in the order they will speak, and then turn it over to them. First, Don Griswold is a senior fellow on state fiscal policy team at the Center on Budget and Policy Priorities. Prior to joining the center, he spent decades serving large multinational corporations. He worked as a Fortune 10 conglomerate's executive tax counsel, a Big Four accounting firm's national partner in charge of its 600-person state tax minimization group, and a nationwide tax litigation partner with two AmLaw 100 firms. We are very glad to have him on our side now, and he will give us an introduction to combined reporting and the rationale for it. Then we'll hear from Elizabeth Fiedler, who represents the 184th District in the Pennsylvania House of Representatives. Before she was elected to the House in 2018, she was a reporter for WHYY. She has long been one of the House's leading champions of combined reporting and other progressive tax policies. Finally, we will hear from Carl Davis, the lead author of the report we're discussing today. He will discuss some of the details of the report and how he estimated the revenue that the report says we can raise with worldwide combined reporting in Pennsylvania. He's the research director of the Institute on Tax and Economic Policy and a world-renowned expert on state, local, and federal tax policy. ITEP provides much of the detailed analysis of federal and state taxes that we draw in our work, much of which is found in ITEP's report, Who Pays? Carl has played the central role in producing 5 editions of that report and many, many other research reports we draw on. I'm really hoping that someday he's able to produce one that does not show Pennsylvania as having one of the most regressive tax systems in the country. So, because Representative Fiedler has to leave by 11:30, we'll take some questions for her after she speaks, but we'll take other questions after Carl Davis speaks. So let me turn it over to Don Griswold now.
Thanks, Mark. As Mark said, previously Berkshire Hathaway's Executive Tax Counsel in Omaha, I'm now a senior fellow with the Center on Budget and Policy Priorities. That's a nonpartisan think tank that analyzes policies aimed at building inclusive prosperity and restoring fiscal responsibility. A couple years ago, I reevaluated why I was helping one of the world's richest humans avoid state taxes, and I switched sides. So now I advise states that, like Pennsylvania, still make their corporate income tax virtually optional for powerful global corporations, while your small businesses in the Commonwealth continue to pay full freight. Pennsylvania tax law is so porous that when I was leading that 600-person state tax minimization group at KPMG, we routinely called Pennsylvania the Rip Van Winkle of state tax policy, asleep in the hills as we drove a revolution that industrialized corporate tax avoidance in the Commonwealth. Pennsylvania tax law discriminates against its own small business community with a tax system that contains a huge loophole that's rigged in favor of the most aggressive corporate global giants run by the world's richest humans. That loophole allows these giants to shift their taxable profits out of Pennsylvania and into affiliates, usually shell companies, in tax havens in the US and around the world. Like most other states, Pennsylvania taxes corporations on their profits, and your tax calculation starts with profits that these companies report to the IRS. So when these giant profit shift offshore to avoid their federal tax, that siphons taxable profits out of Pennsylvania too. How big is the problem? As Carl Davis from ITEP is going to explain in a moment, it's enormous. The profit shifting loophole cost Pennsylvania hundreds of millions of dollars in tax collections every year. This diverts funds away from projects for the common good and into the pockets of those aggressive corporations and their greedy multi-billionaire owners. Let's consider just the three richest humans in the world. Presidential advisor Elon Musk's Tesla, in the past several years, paid zero federal tax on billions in profits. Mark Zuckerberg, his Facebook, is among 6 global giants, including also Apple, eBay, Google, Microsoft, that together underpaid their federal corporate income tax over a period of about 10 years by $250 billion. That's trillion with a T, $250 billion. Let's pick the third richest human, Jeff Bezos. His Amazon reportedly avoided over $5 billion of federal tax in a recent 4-year period. Big problem. So, adopt worldwide combined reporting, which shuts all of this down, eliminates profit shifting, and none of that offshore profit shifting will hurt you anymore. No matter how many shell companies and sham transactions they set up in tax havens anywhere in the world, worldwide combined reporting treats profit shifting as what it is: shifting money from the right pocket of your pants into the left. It's a nothing because you're taxing the whole pair of pants. So, Pennsylvanians, stop acting like Rip Van Winkle. Wake up and get behind Representative Fiedler here, who aims to eliminate corporate tax avoidance in the Commonwealth by enacting worldwide combined reporting now. Back to you, Mark.
Thanks very much, Don. And now we'll turn it over to Representative Fiedler.
Well, that was great, and that was a tough act to follow. Thank you so much, Don, and appreciate your insight and all the expertise you bring from your years of work. So I'm State Rep Elizabeth Fiedler. I'd like to thank everybody for having me. I'm proud to represent South Philadelphia in the State House in Pennsylvania. And I think one thing is incredibly clear. Our tax system is unfair. You talk to people all across the Commonwealth, across the political spectrum, across the urban-rural divide, every divide you can think of, people will tell you the taxes are unfair. And that's especially true, of course, for working people. In our state, it's more beneficial to be a very, very wealthy person or a huge corporation financially than it is to be a member of the working class. And again, that's no secret. Everybody's already talking about it as they're talking about what's happening in DC and also preparing their own taxes. But as you heard, we're not just bad, we're actually one of the very worst on this. And like Mark, I am looking forward to the day when we're able to read a report that doesn't say Pennsylvania has one of the most regressive tax systems in the country. There's a couple of reasons that we are one of the worst when it comes to taxes. Obviously, one of the best at many other things, including football, but I would like to see us improve on the tax front if we could. So our flat income tax and our lack of taxation on big corporations, all of that together means low, middle class, working class, and poor people in the Commonwealth are paying more money than they should have to. And I don't want that for any of the families in the district here in South Philadelphia or across the Commonwealth. No person who goes to work every day whether they're a nurse, a teacher, a doctor, a welder, should have to pay more than their fair share, while all these big corporations are getting away with not paying what they should. So what are the numbers? And you'll hear some more numbers, I'm sure, from Carl. But something that stuck out to me that we've talked about over the years is the fact that the super rich who make more than $700,000 a year. So we are talking about very wealthy people, people who make more than $700,000 a year, are spending only a tiny fraction, maybe about 6% of their income on state and local taxes. And that's not fair because working class and middle class people are spending about 12%. Now, these numbers differ over the years, so I'll leave it to Carl to really cite the most current ones and to talk about how we can fix it. But I think that that disparity is just so shocking when you talk about people who wake up early in the morning, they pack their kids' lunches, they get ready, they go to a job, they work hard, and they shouldn't have to pay more taxes than their fair share, really. It's not a mystery how we could fix this problem. And really to do it would be, it sounds kind of wonky when we talk about taxes, but for me, it's all about valuing working class people and valuing the labor that they put in every day at their job. So to make the tax system more fair, one approach we could take is taxing passive income. I know that's something that Senator Haywood has talked about in the past. That's income from things like net profits, dividends, royalties, patents, copyrights, things you may have, but probably don't have in a huge amount. We could tax those at a higher rate than personal income. And personal income, of course, is just what you make as a teacher, an electrician, a nurse. Because money that's earned by welding a bridge or caring for people in a senior center isn't the same as wealth that's made by a millionaire trading stocks or real estate. At least that's what I think. It's different, and it should be treated differently in terms of taxation. The other big thing, of course, that we're going to talk about today is combined reporting, which is a term we got to find something more catchy, because I know that it's the right expert term, but I think we got to work on that, because it really is at the heart of the problems that we face in Pennsylvania when it comes to tax fairness. We need to close tax loopholes that these corporations are using to avoid paying their fair share. 73% of corporations active in Pennsylvania pay no corporate taxes to the state at all because of things obviously like the Delaware loophole. It's absolutely ridiculous to me that we have a tax system in the Commonwealth that allows corporations not to pay their fair share while expecting hardworking Pennsylvanians to pay more than they should have to for vital services that we all count on, like schools, parks, public transportation, after-school programs, housing, childcare, all these important, wonderful things that make our communities vibrant need to be funded, and they need to be funded by these big corporations. Combined reporting puts an end to deceptive tax skirting practices by requiring that all these companies that operate here simply pay their fair share. I think it's important to note that corporations not only hide income in other states, but in other countries as well, which you'll hear about. That's at the heart of worldwide combined reporting and eliminating the ability for corporations to shift their income offshore. The bill that we've introduced in the past and plan to reintroduce will bring those tax dollars back to our communities. It'll level the playing field, as you heard, not just for individuals, but for small and Pennsylvania-based businesses that can't afford to make up for all of these profits that we should have here in the Commonwealth. Working families need tax relief, and we deserve it. I'm excited to be here today. I'm excited to hear more about the details of this new report. And I am hopeful that in the near future, we will be able to pass legislation to make sure that Pennsylvania is no longer one of the most regressive tax systems in the country, but is actually a leader when it comes to valuing working people. Thank you so much for having me, and I'm looking forward to hearing more about the report.
Thanks very much, Representative Fiedler. And now we're going to turn it over to the lead author of the report, Carl Davis from ITEP.
All right, thank you. Yeah, definitely very excited to be able to share this information with you today. These estimates that we've put together for worldwide combined reporting these make use of a new methodology that we developed painstakingly over the course of many months. And the root of how we do these calculations is a combination of Commerce Department data on the activities of multinational companies and IRS data that have been widely used in the academic literature to study these questions of profit shifting and tax avoidance. We were able to use these data in a new way with the help of the academic literature as a guide and with the help of a lot of experts in the field who generously offered their time to us to produce these estimates that we're unveiling now. The core of how worldwide combined reporting works and the way that we estimate the revenue potential here is that it would move Pennsylvania toward a system where it's actually taxing a smaller share, but of a larger pie. So under worldwide combined reporting, the basic idea is that the state would get a full view of all the profits that companies are earning all around the world. So that's the bigger pie. But then the state would tax a fair share of those profits based not on accounting gimmicks or creative organizational charts, but based on business fundamentals. Like, for example, what share of a company's sales are occurring into Pennsylvania as opposed to in some other state or some other country around the world. You know, those profit figures, those sales figures, those are the key drivers of how this reform works. And those are the key variables that we can get out of the commerce data and the IRS data that allow us, that they're really the engine of what makes the revenue estimating we do in this report possible. And so what we find is that moving to a worldwide combined reporting system, it would be a significant revenue raiser in most states, but it would be an especially powerful one in Pennsylvania. And so why is that? And I think Don explained this quite well, and I'll just piggyback on what he's had to say here. You know, the revenue benefit of worldwide combined reporting, it depends on where you start. So for a state like West Virginia, they already have a partial version of combined reporting on the books. They're already dealing with many of the problems created by domestic profit shifting, where companies are moving profits into states like Delaware to avoid paying tax. And so then the thing that worldwide combined reporting does for a state like West Virginia is it helps tighten up the rules in order to stop companies from moving profits into these offshore international tax havens. Now, in Pennsylvania, clearly you're not West Virginia, and in fact, on the corporate tax front, you have a corporate income tax code that is a lot more gameable than West Virginia's is. Pennsylvania really stands out in this report because it's starting from a place of having a very weak corporate income tax code. This is a tax code that is highly vulnerable to corporate tax avoidance because companies can shift their legitimate Pennsylvania profits into a host of different places as close by as Delaware or as far away as the Cayman Islands or Switzerland. Regardless of where the money is being moved right now, we know that worldwide combined reporting can put a stop to these kind of games. And there's a huge potential revenue upside to this. You know, our estimates are going to show that worldwide combined reporting has about $1.5 billion in revenue potential for the state of Pennsylvania. That's the third largest of every state. And again, how does that happen? Well, the core of the reform is putting Pennsylvania in a position of having full information of companies' total profits. Once that happens, Pennsylvania is then empowered to tax the proper, correct share of those profits based on business fundamentals, not based on how creative corporate accountants and lawyers decided to be when they were dreaming up the organizational structure that they are currently using to avoid Pennsylvania tax. By way of context, this is a reform that's getting an increasing amount of attention around the country. So Minnesota passed worldwide combination bills out of both chambers in 2023. It almost saw them signed into law before they were stripped out at the last minute after some pretty intense lobbying by corporate interests. The year after that, Maryland picked up the baton. Maryland, we saw the state's House of Delegates pass a worldwide combined reporting bill, and that's the first time that has happened in the state of Maryland. And you know, those developments, they're coming on the heels of many years where the debate over worldwide combination, it was pretty subdued. We didn't see a lot of interest in the states, but I think both proponents of this reform and the companies that are opposed to it recognize that this is a topic that's getting an increasing amount of attention at the state level recently. And that's really a reflection of lawmakers listening to widespread frustration among the public with how little corporations are paying in taxes. We know in large part that that is being driven by this kind of aggressive corporate tax avoidance that we see so dramatically in Pennsylvania. When you look at the public polling on these questions of corporate taxation, this is one of those rare areas where we have a genuine bipartisan consensus, at least among the public, in favor of real policy reform that asks more of corporations and that shuts down some of these kind of very creative tax planning and tax avoidance strategies that aren't available to regular people. So our hope with this report is that we can bring some hard information to the debate regarding the revenue potential of this reform, so that we can discuss ways to administer corporate income taxes in a way that move us toward a system that comes closer to reflecting what the public would like to see in the tax code.
Thanks very much, Carl, for your presentation today and for the incredible report that you wrote with some others. It really is, as as tax analyses go, it's one of the most exciting things I've ever read. And I know that's a bit of a joke, but frankly, when you get into the details of this policy, and you get into the details of the report, you see just how complicated it is to figure out what Carl figured out. It really was a really creative bit of policy analysis. But it leads to the conclusion that this policy is just a no-brainer, particularly for a state like Pennsylvania, where we have problems of tax fairness, where we don't have enough revenue. And as I just want to piggyback on one of the last things Carl said, there's enormous public support. Overall, our polling shows that 76% of Pennsylvanians believe that corporations are not paying enough taxes. And that's true in every House and Senate district in the state. You go to the most Republican House district in the state, and 71% of people in that district think that corporations are not paying enough in taxes. So this should be a policy that should fly through the General Assembly. We know that it may not, because there's as Minnesota found, there's a lot of lobbying by corporations against it. But I think this year we're hoping to mobilize people around the state to support Representative Fiedler and other members of the General Assembly, and to support Governor Shapiro, who's come out in favor of combined reporting in some form. And we hope, as he identifies exactly the proposal he wants the General Assembly to pass, he embraces worldwide combined reporting. I don't see any questions in the chat, so I think we can stop here. And I just want to thank our three panelists and speakers, and thank all of you who are here today. And we'll be sending this out to reporters with an embargoed copy of the report later this afternoon, and the full report will be released tomorrow. So thank you all. Great, thanks everyone. I really